Silver just broke out of a descending channel after a 27% crash in a single day. It is now holding at $76.50, sitting right on top of the 100-hour moving average. And right now, most retail investors have no idea what that means or what comes next in the next 30 days. Welcome to Market Flux. If you're new here, I break down what is actually happening in markets while the mainstream media keeps you distracted. Subscribe right now because what I am about to show you could change how you see silver forever. Let us start with exactly what happened. As of February 19th, 2026, silver, or XAGUSD, is trading at approximately $76.50 per ounce. It is down about 1.0% on the day, but do not let that small daily dip fool you. The bigger picture tells a completely different story. Silver entered 2025 at $29 per ounce. By December 2025, it had surged past $64. Then, in early 2026, it broke above $100 per ounce for the first time in recorded history. Then, on January 30th, 2026, silver crashed 27% in a single session. One day. A 27% wipeout. That kind of violent swing does not happen randomly. There was a trigger. And that trigger is exactly what most people missed. Here's the event that caused it. On January 30th, Kevin Warsh was nominated as the next Federal Reserve Chair. Markets interpreted this as a signal that interest rates could rise again. The US dollar surged, and silver, along with gold, which dropped 10% the same day, collapsed hard. Most retail investors watched that crash and panicked. Many sold. Many left the market entirely. But here's what they did not notice happening underneath the surface. The Relative Strength Index, a momentum indicator, had been flashing overbought warnings before the crash. That overbought reading released. The RSI is now sitting at exactly 55. That is neutral territory. Neutral does not mean broken. Neutral means the market reset. Think of it like a stretched rubber band. When silver ran from $29 to over $100, the rubber band stretched as far as it could go. The January crash was the rubber band snapping back. Now it sits in the middle. Not stretched, not compressed. The next move will determine the direction. And right now, as of this morning, that direction is leaning upward. Here is why. Silver broke out of a short-term descending channel, a pattern where prices were making lower highs and lower lows after the crash. That is bearish structure. And silver broke above it. The channel resistance now sits directly at the same level as the 100-hour simple moving average. That is around 76 hours to 76.30. Silver is trading above both of those levels right now. In technical analysis, when a level that was once resistance becomes support, that is called a breakout confirmation. It is one of the most reliable signals traders look for. But there is a complication, and this is where it gets important. The MACD histogram has slipped into slightly negative territory. The MACD line is crossed below the signal line. This happens near the zero level, which means momentum is not fully committed to the upside just yet. Let me explain what this means with a simple analogy. Imagine a car that has been stuck in traffic. The road just opened. The car started moving forward, but the driver has not fully pressed the accelerator yet. That is exactly where silver is right now. The road is open. The direction is forward, but the engine has not fully engaged. That is the technical picture on February 19th, 2026. Now let us go deeper. Let us talk about why silver is at $76 instead of $29 and why the structural forces behind this move have not changed. Reason number one, silver has a structural supply deficit that has now lasted 5 consecutive years. Global demand hit approximately 1.2 billion ounces in 2025. Global supply was around 1.03 billion ounces. That is a shortfall of nearly 200 million ounces in a single year. The Silver Institute confirmed this is the 5th consecutive year of deficits. Supply does not catch up overnight. Silver is primarily mined as a byproduct of other metals. Miners cannot simply increase production because silver prices rise. The supply side is largely fixed. Demand is not. Reason number two, industrial demand is accelerating, not slowing. Over 25% of annual global silver supply was consumed by solar panel manufacturers in 2024 alone. That percentage grew again in 2025. Each solar panel requires between 10 and 20 grams of silver. Global solar capacity already exceeds 1,500 gigawatts. It is growing at double-digit annual rates. Add electric vehicles, which saw silver demand jump an estimated 20% in 2025. Add AI data centers. Add 5G infrastructure. Add advanced electronics. All of these industries rely on silver's electrical conductivity, a property that is uniquely difficult to replace with cheaper metals like copper or aluminum. Silver's role in the global economy is no longer optional, it is structural. Reason number three, the US dollar's trajectory directly controls silver's short-term moves, and the dollar story is more uncertain than mainstream media admits. Silver is priced in US dollars. When the dollar strengthens, silver prices fall. When the dollar weakens, silver rises. Right now, markets are processing the implications of a new Fed chair nominee, renewed tariff tensions, and questions about Fed independence after the firing of Governor Lisa Cook. These are not small signals. These are events that affect the fundamental credibility of the world's reserve currency. Now here's the moment in this video where most people are going to get very uncomfortable. While retail investors were watching silver crash 27% on January 30th and rushing to sell their positions, institutional players were doing something completely different. JP Morgan's Global Research Division has a 2026 silver price average forecast of $81 per ounce. That means from today's level of $76.50, their base case already assumes further upside. Meanwhile, ETF inflows into silver-backed products are reached approximately 130 million ounces throughout 2025. Total silver ETF holdings rose to roughly 844 million ounces, an 18% increase in a single year. That buying did not come from retail investors panicking at every headline. That buying came from institutional portfolios quietly accumulating exposure, while the mainstream narrative was focused on stock market volatility and cryptocurrency headlines. Here is the pattern you need to understand. While you were reading headlines about the silver crash, they were treating $76 as a buying opportunity. While you were calculating your losses from $100 down to $73, they were asking what their cost basis is on the next tranche. The move from $29 to $100 was not speculation. It was a repricing of a structurally undervalued metal against a backdrop of 5 years of physical deficits, exploding industrial demand, and a global monetary system that is slowly, but undeniably, losing confidence in fiat currency. And the $76 consolidation we are seeing right now is not weakness. According to multiple analysts tracking institutional flows, the move from the post-crash levels into the current $75 to $77 range represents a transition from speculative panic buying into strategic institutional accumulation. That is the hidden mechanism most retail investors completely miss. They see the price. They do not see who is on the other side of the trade. But now, here is where the story gets even more important, because understanding what happened is only half the equation. The other half is what comes next, and what the historical patterns in silver tell us about exactly this kind of setup. Let us go back to 2010. Silver was trading around $18 per ounce in the summer of that year. By April 2011, it hit $49.51. That is a 175% move in under 12 months. Then it crashed 35% in just 5 days in May 2011. Everyone panicked. The headlines called it the end of the silver bull market. But here's what actually happened after. Silver bottomed at $32. It then recovered back toward $44 within months. The structural story, monetary uncertainty, dollar weakness, industrial demand, had not changed. The crash was a violent shakeout, not a trend reversal. Right now, as of February 19, 2026, the setup mirrors that 2011 post-crash pattern almost exactly. Silver ran from $20 to over $100. It crashed 27% in one session. It is now consolidating between $73 and $78. The RSI reset to neutral at 55. The breakout above the descending channel is holding. In 2011, after the shakeout, institutional buyers who held through the noise were rewarded. The ones who sold at the bottom locked in permanent losses. History does not repeat perfectly, but it rhymes loudly. Now let us talk about what has not changed, because this is critical. The 5-year supply deficit is still intact. There is no new major silver mine coming online in 2026 that changes the demand-supply equation. The Silver Institute's data shows no meaningful increase in primary silver mining output expected this year. Solar panel demand is still growing. Global solar installations are projected to add another 400 to 500 gigawatts in 2026 alone. That translates directly into more silver consumption. Hundreds of millions of additional ounces required. Central banks are still buying gold at record rates, and that gold demand is pulling silver up with it through the gold-silver ratio. The ratio currently sits around 94, meaning it takes 94 ounces of silver to buy 1 ounce of gold. Historically, the long-run average is closer to 65. That gap represents significant undervaluation of silver relative to gold, and the broader de-dollarization trend, countries moving away from dollar-denominated reserves, continues to accelerate. Russia, China, India, and the Gulf states are all reducing dollar exposure. Precious metals, including silver, benefit from every percentage point shift away from dollar trust. Now I am going to go on the record, screenshot this. By May 31st, 2026, silver will trade at or above $92 per ounce. That is a 20% move from today's $76.50. The catalyst will be a combination of dollar weakness as Fed policy uncertainty deepens under the new chair nomination process, continued ETF inflows, and a fresh leg up in solar-driven industrial demand entering the summer manufacturing cycle. That is the prediction. That is the number. That is the date. Now here are the scenarios with probabilities. Scenario 1, silver breaks decisively above $80 in the next 2 to 3 weeks, confirms the channel breakout, and runs toward $92 by late May. Probability, 55%. Scenario 2, silver consolidates between $70 and $80 for another 4 to 6 weeks, builds a tighter base, and then breaks higher in late March or April, reaching $85 to $88 by mid-year. Probability, 30%. Scenario 3, the MACD stays negative, the 100-hour SMA breaks a support, and silver pulls back to the $68 to $70 range before recovering. This would be another shakeout, not a trend change. Probability, 15%. Now, let us talk about what this means specifically for you, depending on where you stand right now. If you are holding physical silver, coins or bars, the message is simple. You are in the strongest position. Physical silver has no counterparty risk. The supply deficit does not affect you the way it affects paper traders. Your job is to hold and understand the timeline. This is not a 6-week trade. This is a multi-year repricing event. The $76 level is not your exit. It is your foundation. If you're using leverage or actively trading, you need to be extremely careful right now. The MACD signal is warning you that momentum is not fully committed. Do not over-leverage into a consolidation zone. Wait for a clean close above $80 before adding exposure. The risk-reward improves significantly once that level confirms. If you're sitting on the sidelines with cash, you are not late. The move from $76 to $92 is still available. The question is entry point. A pullback towards $73 to $74 would be the highest probability entry. Set your alert now. Do not chase the first move above $78. If you bought at the top above $95 and are currently underwater, you have two choices. Hold and understand the structural thesis, because the 12-month outlook still supports a recovery toward and potentially beyond previous highs, or cut your position size now and re-enter at lower levels to reduce your average cost. Panic selling at $76 is the worst possible outcome for your portfolio. Now here are the 4 indicators to watch from today forward. Watch the DXY, the US dollar index. If the dollar weakens below 104, silver gets a direct tailwind. If it strengthens above 108, expect pressure on silver prices. Watch COMEX silver inventory levels. COMEX registered silver has been declining for months. Any further drop below 100 million ounces signals a tightening physical market that historically precedes price surges. Watch the gold-silver ratio. If it starts compressing from 94 back toward 80, that means silver is outperforming gold, a classic sign of a bull market acceleration in silver specifically. Watch the Federal Reserve's public communications on rate policy. The Warsh nomination introduced uncertainty. Any dovish pivot signals, even small ones, will immediately boost silver. Now, before I close, I want to identify 3 types of people watching this video right now. The first type is panicking. They saw silver drop 27%, they saw their portfolio turn red, and they are already thinking about selling. These are the people who consistently buy high and sell low. Markets are designed to take money from them. The second type is frozen. They understand silver has strong fundamentals. They believe in the long-term thesis, but they are paralyzed by the short-term noise. They are watching, waiting, but not acting. And waiting without a plan is not a strategy. It is just delayed panic. The third type is learning and preparing. They are watching this video, writing down the price levels, setting their alerts, and building a clear framework for what they will do in each scenario. They know markets transfer wealth from the uninformed to the prepared, and they have chosen which side they want to be on. Markets do not destroy wealth, they transfer it. They take it from the people who react emotionally to short-term price swings and hand it to the people who understand the structural forces driving long-term value. Silver's move from $29 to $76, even after the crash from $100, is not an accident. It is a repricing, a structural repricing of an asset that the world cannot function without. And remember what I said at the beginning of this video. Silver is holding above its 100-hour moving average after breaking out of a descending channel. That was the setup. Now you know what it means. If this video gave you clarity that you could not find anywhere else, hit the like button right now and subscribe to Market Flux. Share this with someone who is stressed about their silver position and does not know what to do next. They need to see this. And drop one word in the comments. Holding if you are staying in, or watching if you are still on the sidelines. I read every single one. This is Market Flux. See you in the next one.